important discussion. In this particularly potent moment for global markets, it's a time of rising COVID variant cases, a disrupted recovery, risk of higher inflation, and all at a time in emerging markets and among emerging market-based multinationals that have to face up to some demonstrably increasing demands from investors and other stakeholders on their environmental, social, and governance policies and practices. I'm Andrew Caroli, the Charles Field Knight Dean of the Cornell S.C. Johnson College of Business. I'm also the former director of the Emerging Markets Institute that's being showcased here. It's founded in 2010. The Institute's been dedicated to engaging in the most in-depth and collegial worldwide sharing of knowledge about the role of emerging markets in the global economy. Hosting the annual Emerging Markets Institute conference with partners from all over the world, sponsoring emerging market fellows, and so much more, the Institute really aims to prepare and support business leaders who seek to become experts in this dynamic markets. Each year, the Institute issues a comprehensive look at the issues and forces at play in emerging markets. And this gathering here today is actually commemorating the release of their 2021 edition of the Emerging Markets Multinational Report. You know, in the past 2 years, massive economic disruptions ravaging human costs in terms of infections, illness, and deaths have so tragically befallen our world. Now supply chain disruptions, energy price volatility, localized wage pressures mean heightened uncertainty about inflation and the policy paths to contain it. And just to add to the mix, the downshift in global cross-border direct and portfolio capital flows and trade flows and foreign bank lending and deposit activity all sort of trace back to the global financial crisis around 2007, 2008. These days, many are asking whether financial globalization is in reverse. You know, scholars are actively divided over the forces that are at work, that are weakening financial globalization after, essentially 6 decades of sustained expansion before that. Emerging markets and emerging market multinationals actually might be absorbing the brunt of the pandemic, maintaining its grip, the adverse consequences of the tightening of monetary policy designed to curb inflation and the risks of financial stability and geopolitical tensions, let's not forget them, that are impeding the free flow of capital. Look, the questions are many, and the time to answer them honestly is now. And I want to commend Doctors Lourdes Casanova and Anne Maru for their incredible work here we're about to discuss. The progress of financial globalization is a complex, open question. The 2021 edition of the report, in it, Lourdes and Anne have delivered a volume that does not shy away from the complex questions. And today they're going to be joined by a remarkable group of people with international expertise in policy, teaching, research, finance, including some of the EMI fellows to discuss preparedness, practices, implications of all of this for the coming decade, honestly. I do want to close, if I can, before I hand off to Dr. Casanova, with some exciting news that complements all this importance of this emerging market multinational report. This year, the Cornell S.C. Johnson College of Business received a $1.8 million gift from Gail and Roberto Canizares, BS 71, MBA 74, which will provide substantial support to the Emerging Markets Institute in our college. You know, this gift augments Gail and Roberto Canizares' gift for the directorship of the Emerging Markets Institute Fund, which they established with another $1.5 million gift in 2018. Honestly, I encourage you to learn more about Roberto and Gail's generosity and really help me to thank them for their visionary support. So with that, I'm going to hand the floor over to Dr. Casanova, the Gail and Roberto Canizares director of the Emerging Markets Institute. Over to you, Lourdes.
Thank you very much, Dean Andrew Caroli, for the opening of the webinar. We are now launching the 6th EMI report that is authored by Anne Miru, my colleague, and myself, and building the future on ESG excellence. So we welcome all the partners who have been with us some from the very beginning, and some joined later. Very grateful to all of them, because this report is not only the effort of Anne and myself, but also the result of all the discussions during the whole year with the EMI research team, with students at Cornell, interns, and of course, our partners. And we have them all here, so thank you very much. So first, Lorenzo Pavone, Deputy Head of Networks and Partnerships and Gender Division at the OECD Development Center. James Zahn, Director of Investments and Enterprise at the United Nations Committee Trade and Development, UNCTAD. Gautam Jain, Research Fellow at the Emerging Markets Institute. Veneta, who is the Dean of the School of Management at the Universidad de los Andes in Colombia. Xuelin Bu, who is a PhD candidate at the School of Economics and Management at Wuhan University in China. Momina Aijazuddin, Global Head of Microfinance and Finance Inclusion at the International Financial Corporation, IFC. Erika Chicola, Operations Senior Analyst, Office of Outreach and Partnerships at the Inter-American Development Bank. Actually, the IDB just joined this year. So I would like to start presenting part of the results, and Anne will continue, and then our partners will talk about their presentations in the report. So please, you can start with the slides. So the first part of the report looks at what we have been looking for the last 5 years. This is the 6th report, and we are looking at how emerging market multinationals perform in the Fortune Global 500. And this year, it already happened last year, the number of companies from China was bigger than the number of companies from the US. So 135 versus 122. However, you will see the size of the balls. The size is bigger for US companies because the total revenues of US companies is bigger than the total revenues of Chinese companies. This year, we started another exercise that was to look at how Chinese companies, next slide, perform versus other emerging markets. And that what is interesting is that if we compare the economic growth of emerging markets, has been always, even right now, higher than the developed world. And we were expecting that with economic growth, more companies will be in among the biggest. And what has happened is that today, in this new phase of globalization, what we call the third phase of globalization, and in which emerging market multinationals, mainly Chinese, have an increasing role in the business competitive landscape. So we see that emerging market multinationals, there are 24, the same number as in 2009. So why Chinese companies have grown more than the rest of emerging markets? For two reasons. One is the size of the economic market of China, and the other, it has been the support of the government. So next slide. So there have been winners and losers. We have seen that the US, the number of companies have gone from 139 in 2010 to 122 in 2021, but also Europe, that has gone from 107 to 81. Mainly UK has lost quite a few companies among the biggest one. Japan as well, 71 till 53. This year again, we look at what is the number of companies with revenues more than 1 billion in the world. So we were wondering if this holds true also with a bigger sample of companies. And yes, if we look at all the billionaire companies by revenues, we have China with 23% of those companies, with 1,676, and US with 1,440, 20 companies. Then Japan, South Korea, that was considered an emerging market till recently, UK, Germany, Canada, and India. India number 8 with 2.3, 163 companies. Then we also measure and keep track on the overseas M&A and overseas also FDI greenfield investments. So what we see, and we compare the US in blue and the China in red, we see till, let's say, 2018, a very important activity of Chinese companies buying overseas. And by countries, the biggest destination of these overseas acquisitions is the US. By a region is Europe, but by countries is US. So, and definitely we see that this is a tremendous activity, but then till after 2019, and definitely in 2020 and 2021, this overseas acquisitions activity has diminished, while the US keeps on being really the king, the most important acquirer in international arena. In the next slide, we see also the comparison, and we see that these are the 10 biggest countries by international acquisitions, and we see that the US dominates with 36%, followed by UK, France, Japan, Germany, Canada, China, Netherlands, Singapore, and South Korea. And then another exercise that we do, there are two types of overseas acquisitions. Overseas activity. One is acquisitions, and another one is greenfield investment. So here again, comparing China, US, Japan, and other countries, we can see that overseas, next slide, overseas FDI greenfield activity by China has been and still is very important, and in the year 2016 even was bigger than the US.
Thank you very much, Lourdes. So I will try to, in a few words, encapsulate what we did, but I encourage you to read the methodology in the chapter because we have gone through a very long and quantitative exercise, thanks to colleagues of the EMI team, and in particular our lead researchers, Daniel Dos Santos. So what did we do? We looked at the company which have more than $1 billion in income and which have an ISIN. Why an ISIN? Because you need that for econometric and manipulation of data. Initially in the world, we found that 7,100 and more companies were meeting these criteria. And out of these 7,100 and so companies, we took those which are headquartered in an emerging market. That gave us 2,256 companies. And then once that was our sample of enterprises on the one side. On the other side, we used the ratings provided by rating agencies. We did not do the rating ourselves. We used what was already existing, which in itself is a very, very difficult exercise. And we looked at about 18 or 19 rating agencies to try what data we could use. We cut down those we could really use to about 9 rating agencies. Why? Because many of the rating agencies nowadays do not cover at all or cover very little companies from emerging markets. So that was already a first challenge. And the other challenge was to be able to put together this information. So out of these 9 rating agencies, we did an average of their score, which was attributed to each company. And I must say that the criteria for a company to be considered in the top performers was to be able to have 3 data points. Out of this large group of companies, we took the 200 top performers. And if you want, next slide. The next slide is about the result. I will go very quickly on that, but there are 2 interesting points to highlight. The first one is that while at the beginning, in our sample of 2,200 companies, 60% of the firm were Chinese. In the top performance, we have only 25% of the firms which are Chinese. And this is a very big difference. One of the reasons for that is that we think that the reporting is not done in such a way that it can be taken into consideration by rating agencies from other countries or more advanced environments. And by the way, for the Chinese company, we used a database which is called WIN, which is a kind of Chinese Bloomberg, if we want, because we needed that information to cover the Chinese company. And there is already there, you can say, a major difference between these 2 groups of firms. The other very interesting results, which could lead actually to further study, is that you have a very South Africa and Thailand are countries which in the initial sample had a very small presence, less than 3% of the firms in the initial samples. But in the final results, we find Thailand and South Africa among the countries which are ranked at the top. They have a significantly or a relatively important share of the top 100 performance. And actually, to try to look at what was happening, we looked at the institutional framework, the regulation, the voluntary initiative, and these two countries stand out as far as the laws and the regulations and the initiative are concerned. Thailand has a particular, has been very strong, for instance, on environment, but also on social, for obvious reason, I would say, but partly for the tourism and the fishery and so on. And South Africa also has a very strong network of laws, regulation, initiatives, partly as a result of the fight against apartheid. So this opens, we believe, an area for research to try to understand the context of the countries and what the companies from these countries are doing. And that's further a thought for researchers, I would say. Next slide. And next slide, because now I'm going to talk about the other issue, which is very important this year in the emerging markets multinational report, which is about our group, or a definition of emerging market multinational, and what is an emerging market. When we began this exercise in 2016, we set up a group of top 20 emerging economy. The idea is that because we were looking at the phenomenon of emerging market multinational and emerging markets, it was important to be able to define more or less the animal, which would be representative of the change which has been taking place. It's a major change in the global economy. Next slide. So this year, we revisited this list. And for that, we first we took into consideration starting point, all economies in the world. Second point, we exclude those who are classified as advanced by the IMF. And also those for which the data, the information is too old, more than 3 years old, which means, for instance, that we could not include Venezuela. Second step, if you want, we built up a score for each of the country, which would take into account the GDP per capita, and we gave it a weight of 0.4, the share in total trade. The reason is that we wanted to, if you want, take into account the importance of the presence of the particular economy in the global economy, and then the poverty level to give also, to reflect the development aspect of the development of the economic concern. So we ended up with about 40 or a little more than that, 42 economies. And out of these, we took those with the 20 largest GDP. And on the slide, you may see the E20 plus 1. E20 plus 1 is the group that we are going to use now. And what is a plus 1? Actually, plus 1 simply refers to China. In all of our grouping, China is number 1. And some people say, is China an emerging economy? We have to recognize that on the one hand, it has characteristics of an advanced economy, just tech innovation and technology. But on the other hand, the GDP of the country is a little more than $10,000 per capita. And there are still almost 400 million people who live at $5.5 a day. So it's not yet an advanced economy. So we still consider it as an emerging economy. Hence, E20 plus China, or E20 plus 1, is the group that now we'll be working on. And this group accounts for for basically 44% of global GDP, which illustrates how important it has become in the global economy. And I will stop there. Thank you very much.
Okay, now Lorenzo, please.
And I pass the floor to Lorenzo. Sorry, Lourdes, I should have.
Thank you, Lourdes. Thank you, Anne. It's a pleasure to be here and to present our contribution to your report, titled this year, as far as our chapter is concerned, Path to Progress for Business and Sustainability in Emerging Markets. So I hope that now you can see my first slide, which shows three main points that I want to address. First, that ESG, sustainable finance, and sustainable business, more broadly speaking, is gaining traction. Second, this trend is also key in a moment of economic recovery, in a moment where we need to find every possible ways to recover from the pandemic. And third, there are some still challenges that need to be addressed to make this sustainable finance market work well. Next slide, please. Now, on gaining traction, what I can say is that the importance of sustainable business has grown considerably during the last decade, as companies have come to understand the importance of putting sustainability at the core of the corporate strategy. Indeed, sustainable business is an important tool to attract investment, to create new business opportunities, but also to retain talents. That people now want to work for companies that have a purpose. The salary is not just the only criteria for people to find the job that they want to do for their life. So sustainable finance, ESG criteria, sustainable bonds, green bonds are becoming progressively more important, and this is even happening during the economic crisis, in spite of potential tensions between long-term investments, like those that make, let's say, sustainable business work, because you need investment upfront, and short-term profitability, which is now a bit challenged by the current economic context. And there are cases where there's been a pressure from the top to sort of make businesses be profitable in this context at the expense of, let's say, investment in sustainable activities that will generate results a bit later on. So you can see from the slide that globally almost $1 trillion of assets were held in sustainable funds at the end of 2019. And this is an increase of more than 30% compared to 2016. That recent estimates actually show that the asset size of sustainable funds is now around almost 4 trillion. So this exploded in the past couple of years. One important aspect also to mention is that the bulk of ESG assets remains still concentrated in developed economies. So the slide shows the share of market coverage pre-pandemic and the leadership of US companies now in this context. With respect to sustainable investment, the European Union leads in total assets committed, and followed by the US and others. This is despite the fact that many companies from emerging markets are, for example, particularly vulnerable to environmental factors and might actually be very much interested in in having more sustainable finance flows coming from the private sector. Next slide, please. Now, if you're looking at exactly at the context of the recovery, you can see in this slide that comes from the economic outlook of the OECD, and which was discussed at one of our last events of our business network, Emerging Markets Network. Sustainable finance has a key role to play in support of the recovery post-COVID in emerging and developing economies. Why? Because you can see that there is a limited fiscal space for many emerging markets to support the recovery. What happened is basically that these countries, as you can see, have increased substantially their debt. Most of it is particularly denominated in foreign currency. And in a context where interest rates are going up in developed economies, obviously the burden of this debt is becoming even higher. This in a context where there is already a fiscal deficit. And this means that these countries will not be able to spend extra money to support the recovery in their economies. So in this case, obviously, the private sector can play a critical role with not only technologies and investment, but also with additional finance to support actions in favor of social and economic recovery. On climate, even more, we have estimates from the International Energy Agency, the sister agency of the OECD, that 70% of the investments that are necessary to meet the climate change need to be done in emerging and developing economies. In a context where the governments, again, don't have money to do that, it's critical the role of private sector and sustainable finance. Next slide. However, not everything looks good. While investors are increasingly interested in ESG products, in the ESG market in general, there is still a need for more consistent, comparable, and verifiable ESG data, and to use them in a more consistent way. First of all, there is a lack of correlation among various ESG scores across the leading providers that produce these scores. This is caused by the fact that there are different methodologies that are applied. This also applies in general by, this is also an issue when companies themselves want to show their strategy on sustainability and their work in this space, where we still lack some consistent parameters that can be sort of standardized and utilized for everyone. As far as ESG score is concerned, for example, a company might have a high ESG score from one provider and a much lower from another one. And this has obviously an impact on the way ESG can properly inform investment decisions, as opposed, for example, to credit ratings, which are found to be more consistent in their evaluation across different providers. Another point is the close engagement and cooperation between key stakeholders that will maximize the positive impact of sustainable investment. Public-private dialogue, for example, blended finance, public and private finance, policy discussions are key factors to channel the investment where is needed, channel private investment where is needed for public objectives, to lower the risks of investment risks, to facilitate even more investment in emerging markets, and obviously to adopt more solid ESG criteria to assess investment and get some specific objectives. Finally, I would say that global initiatives are welcome to seek to create a set of common measurements and reporting criteria that will be key to progress in this area. And there are many that are currently ongoing, and I'm not going to enter into these details. I stop here. Thank you very much for the attention. I now pass the floor to James Jean from UNCTAD. James, the floor is yours.
Thank you, Lorenzo. First of all, I wish to congratulate Lourdes and Anna for another outstanding report, very unique niche in this overall space of multinationals and international investment. And this year focusing on a very key issue that is sustainable development, ESG. For our chapter, the contribution, we're so happy to contribute to this report this year again. And our focus is on sustainable finance and the developing economies, basically to cover the trends, the policies, and the lessons learned. So it's kind of the 3 dimensions. It's the chapter builds on the work undertaken by UNCTAD in our World Investment Report last year that I'm heading that, and basically to match, to map the sustainable finance market, and it's in terms of the products, policies, and regulations, and to assess the real impact of the sustainable finance market on sustainable development and its contribution to the SDGs, especially in the emerging market economies. So, and the paper also offers kind of a policy recommendations for further leveraging capital markets on sustainable development. So this is all in our contribution to the report. Now, first, allow me just to highlight sustainability themed funds, the trends. So over the past 5 years, the fund industry has been rapidly embracing sustainability through the multiplication of funds and indices dedicated to sustainability themes. In 2020 alone, sustainable funds surged, including mutual funds and ETFs. And for that, we have seen a tremendous progress made in this area. And these funds now represent 3.3% of the assets of open market funds worldwide. The vast majority of the sustainability themed funds are domiciled in Europe, and basically 73% was domiciled in Europe, followed by North America, that's 18%. And for the emerging markets so far, it remains largely absent from the sustainable funds market. And in total, they host about 8% of the world's sustainable funds by number and less than 3% by assets. Despite the benefit of sustainable funds being mainly limited to developed economies, some emerging markets have seen robust growth in their sustainable funds industry in recent years. For example, in China, that's the largest emerging market host economy. There were over 100 sustainable funds with assets under management of nearly $20 billion as of 2020. Most of them were created in the last 5 years. In terms of the number of funds, China has become the 8th largest sustainable funds market in the world in 2020. In the meantime, sustainable funds have also experienced rapid growth in other emerging markets such as Hong Kong, China, Singapore, India, and Brazil, despite the fact it's still at a low level. So this strong growth momentum is expected to continue, according to our estimates. That will be mainly due to two factors. First, most of the developing emerging economies have integrated economic, social, and environmental sustainability factors into their development plans. They will also offer kind of huge opportunities for sustainable investment in a wide range of SDG sectors, such as pharmaceuticals, renewable energies, sustainable infrastructure, and affordable housing. And the second factor is that emerging markets are making significant progress in putting in place the necessary policy framework, standards, reporting measures, and incentives to support the development of sustainable finance. Of course, there's another factor, in fact, that stock markets in developing and emerging economies account for roughly 23% of the global market capitalization. So which suggests that these economies have potential to significant growth in funds market. So on one hand, the sustainability funds in the emerging market accounts for 8% of the global share. But in terms of the overall funds, it is roughly about 23%. So you see there's great potential, and that includes their sustainable investment segments. However, the sustainable funds market is still in its early growth stage. As long as these funds remain concentrated in developed country markets, the real impact of the global sustainable funds will be geographically limited. And in fact, the sector is also limited, basically it's more focused on renewable energy sectors compared with many other sectors that relate to sustainable development goals. And in the meantime, we also observed that the kind of self-labeling nature of many sustainable funds, and there's a lack of consistent standards. And this also raised the concern about ESG washing and SDG washing. So the global sustainable funds market, therefore, needs to address the two fundamental issues to fully unleash its potential to finance sustainable development. First is how to make sustainable funds contribute more to sustainable development in emerging markets, and particularly in the poorest countries. And the second is how to improve their sustainability credentials and to address ESG or sustainable development goals watching concerns. Now, the second aspect relates to kind of sustainable bonds markets. I just wish to give you an overview. The global sustainable bonds market exhibits a kind of a similar growth trajectory to the sustainable funds market. A surge was witnessed in the recent past, but much of the growth has been concentrated in the developed markets again. So the sustainable bond markets, including green bonds, social bonds, and mixed sustainability bonds, that is the mix of green and social, has been has seen an enormous growth since the first green bond was launched just over a decade ago. So based on the 2020 explosive growth rates as a direct result of the responding to social and the public health consequences of the COVID-19 pandemic, social and mixed sustainability bonds are rapidly catching up with the green bonds segment, and it's becoming increasingly popular tools for financing SDG-related activities, including the developing and emerging economies. So accumulatively, the total amount of the outstanding sustainable bonds since 2015 is estimated to be $1.5 trillion, and this is based on the average maturity periods for these bonds. The issuance of green bonds, social bonds, and the mixed sustainability bonds reached 300 billion, 160 billion, and 140 billion respectively in 2020 and in the emerging markets. So since 2012, 43 emerging market economies have issued green bonds, a registered cumulative issuance of 226 bonds. That's what we see. China, for example, in 2020 was the largest green bond issuer in emerging markets, with a new issuance of $18 billion, and this is despite a fall in issuance as a result of the lockdown and the project delays due to the COVID-19. And the emerging market green bonds issuance was resilient, increased by 21% to $22 billion, and the largest ones Chile, Brazil, and Indonesia. And these are the largest issuers in 2020. While a number of new players, such as Egypt, Kazakhstan, and Saudi Arabia entered the market as well, we see that there are other countries getting prepared for launching the green bonds. So among the emerging market, India has the second largest volume of outstanding green bonds. It's about $10 billion, and has consistently been the second largest issuer after China. So in 2020, however, India's green bonds issuance dropped significantly, as we know that suffers from the pandemic, but still remain at high level and remains a kind of attractive market, bond market. So in terms of targeted sectors for bonds, infrastructure and the public utilities are the critical ones that for long-term development and emerging economies, they dominate. And the renewable energy, transport, water, building, and the water, building and the waste accounts for over 90% of the accumulated deployed proceeds of green bonds since 2012. So this is about the emerging market. I think I've thrown in too many numbers, but just to give you an idea of the current trends. And the paper also dealt with the issues like looking at the kind of latest developments in sustainable finance policies and regulations in emerging markets. And due to the time constraints, I will not elaborate on that aspect. You may wish to read a chapter in the report. There's a national dimension and international dimension of the policies, particularly in developing countries in the sustainability space. Now, to conclude, the capital markets can have a kind of decisive impact on the level and the direction of sustainable finance and can contribute towards filling the investment gap for the SDGs, especially for developing economies. There has been a kind of proliferation of sustainability-themed finance products in recent years, including sustainability-themed funds, bonds, and debt instruments. Nevertheless, these sustainability dedicated products have not been able to effectively channel much needed investment into key SDG sectors at scale in developing and emerging economies. So in this context, government in those economies should step up efforts to leverage sustainable finance for development and investment in SDGs. A number of them have made notable progress in putting place the necessary framework, standards, and policies and regulations. However, the regulatory and policy framework in most countries remain patchy, and in many cases, the process is very recent. So to continue growth and ensure concrete impact in developing and emerging economies, the overall long term, the sustainable investment markets needs to address triple challenges. First, the magnitude. So the sustainable finance in emerging markets is still in a very early stage and remain negligible as a share of the global sustainable finance market. The second is the quality. The lack of standards and limited availability of high quality data raise concerns about credibility of ESG and SDG products that I mentioned, and also to measure the impact. The third is the fragmentation. So the market fragmentation risk remains big. The limited size of the capital markets in many developing countries, emerging economies, means that development of sustainable finance in these countries are heavily reliant on the regional global market. So with all these, there's a need there's no one-size-fits-all solution. And each economy needs to develop a kind of sustainable finance strategy and a framework that suits its development levels. However, the key building blocks for an enabling ecosystem for sustainable finance are the same for developed and developing countries. So which that could include kind of national strategies, taxonomies, labeling rules, policies and regulations for disclosure and reporting, and incentives on the demand and the supply side to support products and the market development. So I just stop here. I think I've taken too much time. Thank you.
Okay, Gautam Jain, and we'll go to slide 26. Please, Gautam.
Thank you very much, Lourdes and Anne. So in my chapter, I looked at green bonds with a focus on emerging markets. So in that sense, it should connect very well with what James and Lorenzo spoke about a few minutes ago. So essentially, a major issue that leaders around the world are trying to tackle is how to finance the transition to net zero emissions. And green bonds can help bridge this gap. Essentially, green bonds differ from other fixed income instruments as the proceeds are ring-fenced for specific climate sustainability projects. And to minimize the risk of greenwashing, the issuers are supposed to seek second-party reviews and third-party certifications. So I'm assuming we're on the first slide. So essentially, it's not surprising that the green bond market has grown rapidly in recent years. A total of $1.8 trillion worth of green bonds have been issued since 2007. Just last year alone, over 600 billion were issued, which was the double of what was issued in 2020. And for this year, 2022, the projection is the issuance will exceed $1 trillion total. Next slide, please. As spectacular as the growth of green bond market has been, with the exception of China, emerging markets have broadly been left out. If you look at the breakdown by country, only about 12% of green bonds originate in EM outside of China. The breakdown by currency is even worse for emerging markets. Only 3% of issuance is denominated in currencies other than developed market currencies and the yuan. What this means is that there's very little issuance from emerging markets, and whatever little issuance is there it's primarily in dollars and euros and not in local currencies. Next slide, please. Now, why is it critical that the share of emerging markets in green bond market go up? This chart shows that the forecasted increase by the end of the century in the number of days per year when temperatures exceed 95 degrees Fahrenheit or 35 degrees centigrade, the so-called wet bulb temperature, as compared to the average that existed between 1986 and 2005, based on two scenarios for greenhouse gas emissions. So as this chart shows, that while climate change is a global problem, emerging markets will bear the brunt of it. So that is why they need to be, finance the transition to net zero emission. And for that, green bonds can be pretty critical. Next slide, please. I will end with this slide. I have listed here some of the reasons why the green bond market has eluded emerging countries so far, and some of my suggestions on how to address them. The main issue is with regards to the perceived cost, which I believe can be addressed by better education for some of these issuers, whether it's corporates or sovereigns, and by using innovative bond structures. Another issue is the lack of liquid domestic markets in many emerging countries, which can be addressed by issuing global bonds in local currencies that settle in euro clear. This is a way that this approach has been used in the past in another context, and we can reuse it. Finally, there are no indices and there's limited coverage by rating agencies for emerging market bonds in general, but also emerging market green bonds. This is sort of a chicken and egg problem in the sense that once the issuance grows, indices will come about, they will be created, there'll be more rating agencies covering them, and then it can become a virtuous circle. So I will end there, and I will pass it on to Vanessa and Danova of on this.
Thank you, Jane. Thank you so much to all the panelists and to Lourdes and Anne for the opportunity to feature in this very ambitious and impactful report the opportunity that ESG endeavors keep for Latin America. This is a work that has been developed jointly with my colleague from Uniandes, Juana Garcia, and an excellent young researcher, Juan Pablo Huerta. So I would like to argue that Latin America presents a fascinating case study regarding ESG, as most Latin American economies are squeezed in the middle income trap that is characterized by an apparent contradiction between economic stagnation and the relatively good theoretical prospects for growth. And there is a certain flare of optimism in the region as some companies have been able to redesign their business models. And there is an expectation that that can be scaled up into a larger opportunity to leapfrog to the highest international standards using ESG, and thus potentially becoming poster children and effective implementation of this type of strategy for everybody else. And this opportunity for Latin America actually has been articulated mainly because there are huge demands of preserving biodiversity in this region. Of course, there is the pressure to try to stop climate change, and the region has been hard hit by a process that is already ongoing. And of course, the burning issue of inequality that requires urgent innovation and adaptation of the business strategy of companies. And in our research, what we did is we basically use data on ESG standards across the large multinationals from Latin America, the so-called multi-Latinas. And we looked at the quantitative data and indices, but we also took a deeper dive into a number of case studies in order to understand how this paradigm of ESG actually connects with the business strategy of these companies that make the region competitive on the international markets. So there is certainly an agreement that the relatively weak institutional setup of a number of Latin American countries and the difficulty to guarantee public services and a good quality of life in vast territories of the subcontinent, many companies have been long engaged in corporate social responsibility, where companies, instead of the state and the government, actually provide for education, healthcare, security, and so forth, in exchange for the license to operate in these places. Normally, these type of situations are related to some natural resources that are in specific remote areas where the state is not present completely or entirely. However, beyond these case studies, we certainly found a major deterrent for understanding better the ESG phenomena in Latin America because of the lack of data, and the standardized reporting tools basically are not so standardized. And therefore, we can only rely on fragmented and partial information regarding the ESG dimensions. So with this important disclaimer, we have a few findings to share. One of the aspects I would like to call the attention upon is an important challenge regarding the strategic thinking and training of the business leaders of the Latin American companies along the ESG standards. We certainly could find large multi-Latinas that are recognized globally for their role on ESG dimensions, and I will mention some of them. For example, Natura from Brazil, Nutresa, Sura and Bancolombia from Colombia. But in terms of how to think of the operationalization of the ESG ambition is something that needs to attract the attention of educators and policymakers, as a lot can be done on this aspect. Next slide, please. Well, despite the fact that there is a different degree of commitment to ESG, it's certain that there is a growing number of companies that commit to their social and environmental policies to responsible behavior. And that's very clear, for example, in the growth of the B Corps in the region. And of course, companies from Argentina, Bolivia, Chile, Colombia, Ecuador, Guatemala, Mexico, Nicaragua, Peru, Venezuela. I mean, everybody's there. So companies are buying in to this trend, and they are trying to experiment with business models and strategies. However, how does the global indices look for Latin America is a totally separate question. And I'd like to share with you our findings based on the Standard & Poor's Emerging ESG Index, and to share with you some mixed news for the Latin American region. Since the launch of the index in 2019, the Latin American regional subindex outperformed the other emerging indices by a significant margin. However, the COVID-19 crisis impacted the index for Latin America the hardest. While the performance of the Asian companies in the ESG index has shown resilience to the effects of the global pandemic, the Latin American performance has suffered and has not recovered yet. So we see here that we should address not only the strategic rethinking of the business models of the big companies in Latin America, but also the resilience of these models to external shocks of the type that the COVID-19 pandemic represented. While we disentangled the Latin American index, we also found some interesting insights we'd like to share with you. We found that Chile and Colombia show the weakest performance among the 5 countries that are included in the Standard & Poor's ESG index for Latin America. And our hypothesis is that it's probably related to the social protests and the long-lasting strikes that were experienced by both countries. And I'd like to call the attention to the pressure that both Chile and Colombia had experienced recently regarding kind of the rewriting of the social contracts in these countries. Peru has an average performance, but honestly, we cannot draw very strong conclusions as there are really few companies in this index representing Peru. And the best performers are Mexico and Brazil, which has been already mentioned in this panel as one of the places where there is a strong drive towards ESG, available funds, and certainly the positive returns that we observe in the index are consistent with everything that we have shared here with you. And of course, as I mentioned, we did an in-depth study of the ways in which business models have been tweaked in the case of banking for Bancolombia, in the case of Natura. We looked at the way their a strategy regarding, for example, the governance component of ESG and the environmental component was brought into the core of the business strategy and value proposition, and the ambition that LATAM has shown in terms of the development of production of aviation biofuel in Brazil. So you can look at these case studies in the report. And as a conclusion, what I'd like to state here is an invitation for all of us to look at the opportunity that the ESG holds for Latin America. The 80s was the lost decade for Latin America, and honestly, there is a legitimate concern that a post-COVID situation and the lack of possibilities to fund a rebound from the public domain can turn into something similar. And ESG can be seen as a driver for innovation and value creation in ways that the region actually needs urgently. And therefore, we would like to end up with a rather optimistic hypothesis for Latin America. And that is that ESG can be used as a tool to leapfrog more traditional business models and ways in which corporations have been creating value in the region, and basically turn into an opportunity for business leaders to rethink what they are doing and turn themselves into players' positive impact to the very complex social and environmental context in which they function. Therefore, nailing down the business models of these efforts, we think still remains the biggest challenge for corporations. And we think that that has to call the attentions of School of Managements and scholars so that we support these efforts from the platforms on which we are called to shape the society and the business leaders' thinking. Thank you so much for your attention. And I'd like now to give the floor to Olivia from Wuhan University.
Thank you, Anita. And thanks to the EMR team. It's a great honor to be part of and contribute to this project. In Chapter 6, we investigate how the corporate social performance of EMNCs change as they become more international by using the data of Chinese listed multinationals. The research idea is coming from the conflicts between existing theory and the real case. Next slide, please. Some previous studies believe that the firm's internationalization will improve their CSP outcomes. However, Chinese multinationals tells a different story. I think many of you have watched the documentary American Factory released by the Netflix in 2019. The Fuyao Group, a Chinese glass manufacturer with rich experience in doing business internationally, refused to integrate into the labor protection system in the United States. We are wondering, except for personal style, is there any objective reason supporting the founder's explicit refusal to be responsible? Next slide, please. We first come up with 3 types of constraints on CSP outcomes, which are institutional constraints, resource constraints, and capability constraints. They each address whether, with what resources, and how issues related to a company's social involvement. As a new player in the global market, EMNCs are usually at a disadvantage regarding all 3 constraints. Internationalization brings more severe competition and multiple stakeholders to EMNCs, causing them to face the dual pressures of efficiency and legitimacy. However, they do not have enough resources and capabilities to manage both at their early stage of internationalization, so the trade-off occurs. Next one, please. In the earlier stage of internationalization, considering large capital requirements, poor financial performance, inadequate capabilities, and institutional voids in their home country, it is rational for EMNCs to focus on efficiency, which is critical to their survival, rather than on social performance, which is more relevant to their legitimacy. In the later stage, as the resource constraints are relaxed, EMNCs are ready to improve their CSP. Therefore, we can observe the CSP of EMNCs first declines and then increases during their internationalization, which means their dominant logic changes from efficiency to legitimacy. Next one, please. In addition, Chinese government spends huge number of subsidies every year, covering almost all listed firms, and most of them flow to large companies. For example, 97% of listed firms have received about $28 billion in the form of subsidies in 2019, and over $1 billion among which flow to Sinopec, one of the 2 largest petrol companies in China. So another question is, how does subsidy influence the relationship between CSP and internationalization? At the first stage, government subsidy released the tension between efficiency and legitimacy by providing companies with an easy access to capital. So government subsidy mitigates the downward trend of CSP. At the second stage, resources received from the home country considerably weakens EMNC's dependence on the overseas market, so that such that the higher degree of internationalization can neither represent a firm's strong global competitiveness nor reflects its accommodation to the institutional context of the global market. So subsidy weakens the upward trend of CSP in this stage. Therefore, we believe government subsidy has a double-edged sword effect on the internationalization and CSP relation. Next one, please. To sum up, there are 2 points. First, emerging multinationals will eventually improve their CSP, but not overnight. So maybe a little more patience is good for both EMNCs and their customers. Second, government should be more cautious in using subsidy because it is not good for multinationals' development in the long term. Personally, I do not recommend the subsidy policy, but if we have to spend some money, we suggest giving more subsidies to young, promising multinationals than to mature ones. There are also some other interesting findings that cannot be covered here, which can be seen in the report. Welcome to follow EMR 2021. Thank you. Now I will pass the floor to Erica.
Thank you so much, Olivia, and thank you so much to Lourdes and the rest of the team for what is a great event so far. So I'm Erica Chicola. I am from the Inter-American Development Bank, or the IDB, which for those of you who might not be familiar, is a leading development finance institution supporting Latin America and the Caribbean. Can I go to the next slide, please? We at the bank work with countries in the region to advance sustainable development in line with their unique national needs, international frameworks, and our own institutional strategy. But we are particularly driven by Vision 2025, which is our agenda for driving growth, development, and recovery in the region. Vision 2025 has 5 priority pillars that we believe can be catalytic drivers of recovery. These are regional integration, digital economy, support for small and medium enterprises, gender and diversity, and action on climate change. But we know that across these areas, as Veneta in her presentation earlier mentioned, public financing is likely not sufficient to really address the extent of the challenges that we face in the region, which have been exacerbated greatly by the COVID-19 crisis. That means that across all 5 areas and across the region's development more broadly, we believe that private sector engagement is essential. And indeed, we actually think that Latin America and the Caribbean is ripe and ready for this kind of private sector action. It has great natural bounty, great human capital, and an increasing level of regional integration that can offer exciting business and investment opportunities to different firms. At the same time, its corporate sustainability landscape is quite interesting, and it reveals a dynamic private sector that is increasingly interested in delivering quality goods and services and creating jobs and operating sustainably on the ground. With this in mind, as a bank, we embrace the private sector and consider them an essential ally in filling development gaps, in leading the region out of this crisis, and in ensuring that the next decade is one of prosperity and of development. And we do this through initiatives like Index Americas. Can I have the next slide, please? So what is Index Americas? This was the focus of the chapter that we contributed to this wonderful report, and it is a corporate sustainability index developed by the Inter-American Development Bank and a couple of different partners to recognize the sustainability performance of publicly traded companies operating in the region. The index was created by us at the IDB, our private sector entity, IDB Invest, in partnership with S Network Global Indexes. It is powered using data on ESG indicators provided by Refinitiv, and it receives academic support from the Earth Institute at Columbia University as well. And this initiative has produced a series of products, including a top 100 index that assesses the performance of global companies with a sizable footprint in the region, an index on the performance of multilatinas, and an index also assessing the commitment of companies to gender equality. In addition, we have used Index Americas to produce a series of financial and knowledge products, including trainings and technical support for private sector actors and stock exchanges in the region as a means of promoting sustainability behaviors at the national level across Latin America and the Caribbean. Could I have the next slide, please? So we consider Index Americas to be unique for many reasons, but perhaps the principal reason is that we have tried to look beyond the framework of ESG to add a 4th component that looks at the contributions of companies to the region's sustainable development. This is done by analyzing ESG indicators with data provided by Refinitiv, our partner in the initiative, weighting them using a calculation developed by the Inter-American Development Bank, and then mixing in our own development indicators that we have designed based on the IDB's institutional strategy, which in turn is informed by the national priorities of countries and the challenges that governments are trying their hardest to address on the ground. Since its creation, this unique methodology has helped us achieve many firsts. So we are proud to say that the index is the first sustainability index created by a multilateral development bank like the IDB. It's the first in the region to add this 4th component of the D of ESGD to ESG analyses. And it's the first in the region to achieve full alignment with the United Nations Sustainable Development Goals. Next slide, please. And through all these efforts, we believe the index has been a key tool to achieving some important goals. It has encouraged companies to participate in the region's sustainable development. It puts the region on the map as a destination for sustainable business. It proves that there is a financial value of ESGD for companies. It shows that companies that do well also tend to prioritize some of these important issues. Which helps us kind of get this really important message across that is key to our work with the private sector. And that is that sustainability and development is not just the right thing to do for the region, but also a smart thing to do for businesses. It rewards sustainability champions and helps raise the bar for all other companies operating in the region, which helps us achieve an important goal of making sustainability the norm and not just the goal for companies operating in our countries. And finally, it helps us as a bank and hopefully others with a like-minded mission to identify partners and clients who share our commitment to these 4 important principles of ESGD. And we can move to the final slide. So I invite you to read our chapter and learn more about Index Americas and also kind of our stance as a development institution on all the amazing ways that the private sector can play a role in the region's development story. The region needs this private sector action, and we also believe that working in Latin America and the Caribbean can be a very fruitful, exciting opportunity for the private sector as well. So thank you for your time. And now I'd like to hand the floor to Momina from the IFC.
Thank you, Erica, and thank you all. This was a fascinating hour and 15 minutes, just listening to the amount of rich content that has been generated. And the good news is that if you can't remember a lot of it, then you can look at all the chapters in the report for those who are watching. So, I mean, it's very clear, having heard many of you speak, that nobody needs to be convinced of the need for ESG. I think we are a long way away from, maybe a decade ago, where one had to convince whether the private sector or the public sector about sustainability. My name is Momina Ijazi, and I'm at the IFC, which it's the private sector arm of the World Bank Group. So we're more than just an investment and advisor. We think more strategically about private sector development, bringing together key players around standards and common approaches. So what I heard, and there are 2 trends going on. I think the first is that the pandemic has really shown us this boost in terms of impact investment around the increased awareness of social and economic and environmental issues. So whether it's the debate on climate, access to healthcare, gender equality, racial inequality, there seems to be a move now to address a lot of these issues, whether it's in the public sector domain or the private. I think the second thing you're seeing is that markets are also developing an increased level of maturity. We heard that in many of the examples that previous speakers had talked about, that businesses are really scaling up in terms of reaching some and embedding ESG into it. I think the challenge still remains in terms of having indicators or uniform sets of standards or indicators or how to measure impact. And I think that'll probably be our next challenge. So I would actually like to pass back the floor to whoever wants to address this, which is that there seems to be a lot of examples of sustainability solutions and multinationals who are mitigating and responding to social issues, but very few that have reached scale. And, from where you sit, how do you see the major trends evolving in the next few years? And I think this allies to some of the questions that have even been asked in the chat is how will we really be able to scale up commercial financing of FDI into emerging markets as opposed to emerged or, developed markets? And what are some of the trends that you're seeing? How can one really prioritize ESG? So it's an all-encompassing question, but I thought that it would be a good one, to kick off. So perhaps I just go back. Maybe to Erica, why don't you start with that and also answer the question about is that index that you just spoke about also available in North America? How are you guys thinking about this? And then we can go around the others.
Sure. Thank you so much for the question. So the index I'm happy to circulate the link. It is an assessment, especially the top 100 index of global companies operating in the region. So you will also see multinationals that are there that are prominent global corporations working in the region and those that are operating most sustainably. So the index is, I think, a slice of optimism in the conversation about ESG, because we see how many of these really large global companies are prioritizing ESG. I think increasingly we will see a corporate culture where that kind of sustainable behavior has to be the norm, and where operating sustainably at scale is critical to the success of companies. I think in a region like Latin America, you asked a question about how can we scale up. How can we hope to see ESG behaviors happen kind of at scale? And I think a critical opportunity in our region specifically is in that green net zero economy space. So the region is home to great natural bounty, 30% of the world's fresh water. it's the largest food exporter in a world that needs to increase food production. So I think also highlighting the opportunities for companies, and that's, I think, a role that organizations like mine must play. What are the opportunities? What is the financial potential of investing sustainably? There was a report a couple of years ago by the Business and Sustainable Development Commission that stated that green opportunities in Latin America and the Caribbean could unlock $1 billion worth of revenue for business leaders and entrepreneurs looking to sustainable business models. So I think that the opportunities are there and the scale can really be reached, if as development actors, we kind of help guide the private sector toward these opportunities, and the private sector increasingly adopts a way of working that looks beyond the bottom line to some of these other issues. And as a final point, I'll just note another interesting product that we have that is kind of striving to do this guidance that I'm mentioning is a sustainable infrastructure toolkit. I hope that kind of answered the question.
Yeah, thank you. And actually, I see nodding heads around the screen. So, Vineta, do you want to come in here, and then maybe a couple of others who want to add to this?
Thank you. I just want to add one minor aspect, but I'm fully supportive of everything that Erica mentioned. I mean, there is full alignment between me and what Erica presented here, in the sense that the private sector actually in Latin America lead by example, because they have already been in a position where they dealt with large societal problems in the very recent history. I mean, even today throughout the region. And I'll just mention Colombia and their civil conflict that lasted for many decades, and the private sector actually was a positive force for good in solving much of the suffering, if you want, even though there is some polemic about that. But I do think this is what happened in the region. So my only add-on to this is we need to really frame the minds of the business leaders in order to be more entrepreneurial and risk-taking regarding these new ideas. As I think there still is a need to give them tools to endeavor at a scale in this domain. That's my add-on to the conversation.
I wanted actually to add to that. What is the impact of ESG requirements on development finance? And I'm sure OECD and IMF and so on have questions about it. So we have also to think about it at the same time, because it has an impact which may not be the one that initially was wanted. I just wanted to flag that idea.
Yeah, and actually I wanted maybe others, if you put up your hand, if you want to speak. Part of it is also what barriers are you putting on emerging market multinationals, right? Because they're operating in an environment of lower transparency, lower accountability, lower regulation, and the cost of doing that, of embedding these practices when others are not, can also be a deterrent. So, what are the challenges that you are seeing in terms of how companies mitigate their own impacts and respond to social issues? Because it is a very complicated space to operate in if you're the only, multi in your market who is the first mover. We're seeing this in China and some of the other larger markets as well. Anyone want to hazard a guess at that question? Gautam, Olivia, Lorenzo?
Maybe I just wanted to say that the regulatory environment obviously is important. There are challenges also now specifically related to the fact that this part of the world is still behind in terms of vaccination. There is a higher uncertainty financially, economically, and therefore it's difficult for companies to invest because potentially it's more dangerous uncertainty than negative outlook. Like if a company knows that a country is on a negative outlook, can organize themselves accordingly. But if there is a moment of uncertainty, it's very difficult. In Latin America, there is also a number of political changes, and a new social contract is ongoing. So these are all aspects that have an influence on investment, sustainable or unsustainable. But let's say that even if a country wants to promote sustainable investment, the conditions now in emerging markets are challenging because of all the things that I mentioned.
Yeah. Yeah, no, and the challenging, it's also a time of concurrent trends. So at one point, you're seeing challenges, huge inequality, but you're also seeing this push for digitization and the role of technology in being able to address. So we're seeing a lot of innovative models, for instance, in Africa, where you can address climate change, agri, access to finance, etc. Any insight into how the role of technology can promote ESG solutions or things that you're seeing in your markets?
Can I start on that?
Yes, please. Awesome.
So I think you're absolutely right. I think there are challenges in emerging markets that they always face. And if anything, the COVID-19 proved that exactly that, in the sense that while developed countries got vaccines much faster than in emerging markets, essentially the health crisis that came about was obviously much worse in emerging markets. So similarly, when you think about things like climate change and so on, you can imagine a very similar scenario. Having said that, the challenges are there, but I also think there are opportunities. Like you said, new technologies offer opportunities. So there will be companies that will come about, and they're already coming out, where they're coming up with newer technologies for renewable energy and so on. And to me, my interest is always on the financing side, and that's the part that I see. The need just for to address climate change. The need of investment is about $6 trillion is what OECD estimates, and McKinsey estimates to be $9 trillion a year, which is very large. And we have to find creative ways to finance it. I'm sure there are companies that will step up once you find ways to finance it.
Mm-hmm. Thank you, Gautam. I think, the light bulbs, I'm sure, going off in the Cornell Business School student body as they can think of addressing some of these ESG challenges, like through solutions that the younger generation will need to come up with in order to address these. So I'm just mindful of time. We're on the hour. But so I wanted to hand over to Lourdes and Anne. I mean, this is a really rich report, and it marks the start of a second decade also for EMI. How would you like to envision that this coming year, like what would be your wish list coming out of this this report in terms of ESG?
Yeah. Thank you very much, Momina. Thank you very much, all of you, Lorenzo, James, Gautam, Beneta, Olivia, and Erica, for being with us, as you say. So, but before that, I wanted to say that we are into a tremendous snowstorm in Ithaca, and the eCornell team had to handle the whole webinar from home. So very, very grateful, Chris and Nicholas, for what you have done to keep and I know that there was no power for a while, so some of you lost the connection. So we, against the elements, so we did the webinar. And as you are saying, Momina, we started, so actually to get into ESG was for two reasons. One, societal demand, but also EMI went through a strategic review with members of the advisory council, donors, with alumni, fellows, faculty, the deans, and the idea was, what next? So we were looking at emerging multinationals, like, okay, how they grow, how they go international, how big they are they are becoming, and we were forgetting that the world was changing, and the demands of the young population and also society at large were changing, and we need to be more accountable. We need to be part of the solution, not part of the problem, and we need to face these tremendous challenges that the world is facing in terms of environment. So that's why we started. We had a number of problems that had been constraints. As I said, rating agencies don't always cover well emerging market multinationals and emerging markets at large. So definitely the idea is to continue with you all and the students and Cornell community at large will help us moving into finding a way to both showcase what has been done and also stimulate companies, that's what we, in countries, to continue in this, in becoming, as I said, for the private sector, part of the solution. Anne?
Sorry, I'll go fast because time is basically up. I just wanted to highlight a couple of just couple of elements. The first one is we have mentioned the difficulty for the enterprises, the emerging markets, and that has been to be taken into account. The reporting will also help to get access to finance. I think it's essential to take that into account. Rating in terms of ESG is a major challenge. Efforts are being made, and we must be sure that emerging market firms' specificities are also taken into account so that they are properly reflected. That's, I think, something, one of the conclusions that we had. The other one is that we want to end on an optimistic note. If things are taking place in emerging market, we were really kind of surprised to see in some environments, we mentioned Thailand, South Africa, India, for instance, in the past 2 years has also taken steps. There is still more to be doing, but I think they are also part of the trend, and we have to accompany them, international organization and business school also, by training the leaders of those countries in perhaps moving forward towards what we all aim for, which is basically sustainable development.
So thank you all. And the link has been shared where you can download the report. And looking forward to next one, we will continue exploring ESG in emerging markets with all our partners, OECD, IFC, UNCTAD, Universidad de los Andes, the Emerging Multinationals Research Network, Wuhan University, and all of you. And of course, the newcomer this year, Inter-American Development Bank, looking forward to continuing working with you all. So thank you very much, and thank you, eCornell team. Thank you, Nicolas, and thank you, Chris.
Thank you.
Bye-bye.